Welcome to the Ellsworth Advisors monthly update for February 2024. I'm Kelly Keenan, this is Cameron Mealy, and today we will review the latest economic data, talk about how our portfolios performed in February, and also what our thoughts are on what the outlook is for the next couple months. Cam, why don't you kick us off with some economic news?
Will do. Morning, everybody. Obviously, as anybody who's been watching the market knows, we've been on about a 4-month rally now. The stock market has done very well. We have really two big pieces of news that are coming out this week that'll certainly have some bearing on the market. First off, on Wednesday and Thursday, Fed Chairman Jerome Powell will address Congress on his semi-annual meeting with Congress to talk about the state of the market. We really expect that Fed Chairman Powell is going to strike what continues to be a very cautious tone. I think everybody's looking for direction on interest rate cuts, and what I expect Jerome Powell to say is, we're not there yet, we're data driven, we have not seen inflation come down to where it needs to be, so we still expect some interest rate cuts this year, but I don't think we're going to see them anytime soon. It's most likely going to be back of the year, maybe 1, maybe 2, maybe 3 cuts, but anything more than that I think would be very aggressive, and we'd have to see some significant economic weakness in order to see the Fed get overly aggressive. The one thing they do not want to do is cut rates to try to appease the market, to influence an election. They want to stay above board and really are looking for the data. So that'll be Wednesday, Thursday. On Friday, probably the biggest piece of economic news we're going to get over this next month is the February jobs report. You'll remember in January, the consensus estimate for new jobs in January was about 190,000. The report was an absolutely blowout of 355,000 new jobs, and that took the market, set the market back a little bit. So what we're looking at on Friday, again, we have a consensus estimate of 190,000 new jobs in February. If that number is around 190,000, I think the market will take that as a very positive sign that we are seeing some slowness, that it might be time to start having more of an easing policy when it comes to interest rates. If we see a big number, that's going to continue to enforce the fact that the economy is strong, that employment's out there, that people are finding jobs, that people have disposable income, and that just really is going to reinforce the sentiment that inflation has not been taken care of yet, and there's still more work to do. Speaking of inflation, let's look at the two big numbers we got in February. On February 13th, Bureau of Labor Statistics reported the Consumer Price Index increased 0.3% in January. This is after a 0.2% increase in December. And over the last 12 months, the Consumer Price Index has increased 3.1%. So not as hot as we've seen it, but certainly hotter than the 2% target inflation rate of the Fed. To follow that up, on February 29th, Bureau of Economic Analysis reported that the Personal Consumption Expenditure Index increased 0.3% in January. The year-over-year increase was 2.4%. So again, better number. It has come down from what we've seen over the last 18 months, but still not where the Fed wants it to be. The important thing about that Personal Consumption Expenditure Index report was Bureau of Economic Analysis also reported that personal income increased a full 1% in January. So we're still seeing strong employment. We're still seeing a strong consumer. Those are really two big drivers of inflation. So yet again, it's going to be data driven. Right now, we're not at a place that the Fed wants to be in terms of inflation so that they can begin decreasing interest rates.
Yeah, January, the income numbers being up 1%, similar to the previous year, same thing. We saw a big January. It tended to smooth out. And they do seasonal adjustments. The reality is a lot of people give raises to their employees that start at the beginning of the year. So in my mind, to see a little jump in January tends to make some sense. Not everybody does that, but I think there's probably enough to maybe move the number. We may see that cool down a bit. But the reality is just that CPI number at 3.1%, that's about where it was last July. So we had the big move from 9% down to 3.1%, kind of bottomed out in July, and now it's been floating around. And I think what Powell's waiting for is, a true trend of lower numbers. I think we're going to stick in that 3 to 4% range for a while, maybe occasionally dip into the 2s, but realistically, I think inflation's with us, and from a rate cut standpoint, I don't see anything until, at best, maybe end of the year. The economy is kind of, muddling along right now in, sometimes the news looks good, or, some of the data looks good, some of the data doesn't look as good. But overall, we're kind of in this, not a bad economy, not a great economy. That's where we're at.
And speaking of the economy, if we fast forward and look at the Atlanta Fed's GDP Now growth forecast model for the first quarter of 2024, as of March 1st, the Atlanta Fed is projecting annualized increase in GDP of 2.1%. So that has certainly come down from what we saw in the third and fourth quarter of last year. 2% is about where a healthy, mature economy like the U.S., where economists believe that a good growth number is. So if we're at 2.1% in the first quarter, if that plays out, if we do see a dip under 2% in the second quarter, third quarter, then we start seeing the economic slowdown, then, that certainly would give some ammunition to
normalize rates, bring down that short end, or bring down the short-term rates, which is what is going to happen eventually. It's just a matter of when.
And now the last piece, we've talked about this before, and what could be a big sticking point for the economy and could be a big source of pain to the financial services industry is commercial real estate debt. So this is from Goldman Sachs, a staggering, and this is a quote from Goldman Sachs, a staggering $929 billion of commercial real estate mortgages are on the brink of maturity in 2024. This represents nearly a fifth of the sector's overall $4.7 trillion debt. The composition of the commercial real estate debt set to mature is 27% multifamily, 22% office, 12% industrial, 8% retail, 12% hotel, and 2% healthcare, 17% is others. Large banks don't make up the bulk of the commercial real estate market. It's more your community banks, your local banks, and obviously, anybody that knows, we've had a zero interest rate environment for a long time. Debt was very cheap. A lot of people overspent on real estate portfolios, overspent on build out of real estate portfolios. Now we could be getting to a situation where if you borrowed at 3 or 4%, you're now going to be borrowing at double digits on a refinance. That's going to cut into cash flows. That could put properties, banks into a distressed position, and that could really lead to some softness in the overall economy. Just that shock alone.
Well, the ripple effect is going to be interesting to see. Cameron listed several different sectors within the real estate world, and all those sectors are definitely not equal. So some are stronger than others, and last year about this time we saw Silicon Valley Bank and Signature Bank have issues and basically go under. They were highly concentrated in venture capital world. More recently we saw New York Community Bank have some real major issues. I don't think they've technically gone under yet, but they're on the brink of it.
Replaced their CEO.
And part of that problem was their concentration in New York real estate. So we're probably going to see a couple more banks go down, but I don't think those banks are going to be J.P. Morgan or Bank of America.
It's not going to destroy the banking system.
It's going to be the smaller banks that are most susceptible to this issue, which it's going to cause some pain, but I don't think it's enough to really tank the entire economy. But that's going to be a pressure point that we're going to hear a lot of headline news around as that starts to happen throughout the year. So that is definitely, I would say, a potential risk in the economy right now.
We're still expecting good returns in 2024. There's nothing that says the market is not on an even footing. Again, to your point, Goldilocks economy, not too strong, not too weak. That usually does set up for good returns. Election years usually produce good returns. I expect good returns, but we are obviously, this is going to be, and I think I've said this every year for about the last 20 years, this is going to be the most contentious U.S. presidential election we have ever seen. It's going to be ugly. There's going to be a lot of noise. Both sides are passionate about their dislike of the other side, and it's going to create some headline risk, but at the end of the day, we'll get through it.
Yeah, and that's what we've been saying for the last several months is expect volatility, but the setup, as Cam said, is for the market in this environment, the setup is actually very good. I've told clients this, that I think it will be all said and done a good year, but there's going to be, I think, there'll be a few dislocations. Even the short term thing. In the short term, things are a little bit extended from the stock market standpoint. A 4-month run up. Yeah, we're going to see some kind of pullback. How deep it'll be, probably not very deep, probably not very long lasted, but we are due for a breather in the short term. But bigger picture, the setup is pretty good, throughout the rest of the year, which ties right into where we're actually at with the stock market or the various indices. In February, S&P 500 up 5.2%, pretty big move there. The Dow Jones lagged up 2.2%, NASDAQ up 6%. So obviously the theme being the market's still being driven by the big tech stocks or a handful of big tech stocks. But with the Dow Jones up 2.2, it is broadening out to some extent. The Russell 2000, which measures or really looks at the small cap market or small company stocks, that was up 5.5%. So that's a big move for the Russell 2000. On the international front, the EAFE up 1.7%. Emerging markets, they caught a nice bid, up 4.6% for the month. Year to date, so through 2 months, S&P 500 up 6.8%, great start there. Dow Jones up 3.5%, NASDAQ up 7.2%. The Russell 2000, even though it was up 5.5 last month, now it's up 1.4% for the year. So, small caps are always volatile. I say it every week. The international markets, the EAFE, only up 2.2% year to date, and emerging markets actually negative year to date, down 0.3%. Our portfolios, our growth with income portfolio, which is kind of our balanced portfolio, for February up 3.6%. Year to date we're up 5%. In February, our biggest gainer was NVIDIA, up 28.6%. That stock continues to chug right along. For the year, it's up 60%. So obviously that's a big driver in the S&P and the NASDAQ. Toyota Motor, we took a position in that last summer or last late spring summer, gained 20.5% for the month. Disney, great rebound there, up 16%. Walmart up, a mere 6.4%. Where we felt pain in February, our real estate investment trust down 2.9%. Apple's been on a little bit of a slide lately, and we're probably going to see Apple kind of go dormant for a while, if not lose a little bit of ground. Long term, we like it, but down 1.9% for the month. And our PIMCO Commodity Real Return Fund down 2%. So we're seeing a little stress in the real assets, real estate and commodities. Year to date, I mentioned NVIDIA up 60%, Toyota up 31%, Disney up 23.6%, so nice rebound there. Berkshire Hathaway up 14.8% year to date. Year to date, Apple is down 6%, Microchip down 6%, Honeywell down 4.7%. In our dividend yield portfolio, which is once again a very defensive portfolio, high dividend yielders, but real strong balance sheets. February, nice month there, up 4.3%. Year to date, up 4.5%. So obviously a pretty weak January. Big gainers: Eaton Corp up 17.4%, Caterpillar up 11.2%. Waste Management up 10.8%. Laggards, Verizon down 5.5%. Consolidated Edison down 3%. Pfizer down 2.3%. Year to date, our big gainers: Eaton up 20%. Merck up 16.6%. Waste Management up 14%. Laggards, Pfizer still leading the pack, down 20%. Public Storage down 6.9%, and Alliant Energy down 6%. Pfizer, the story there is, what's hot in the pharmaceuticals right now are the companies that have come out with the weight loss drugs. Pfizer did not get on that bandwagon, and their stock is paying the price. Long term, it's still a strong company, but right now a lot of things are being headline or narrative driven, and they're not in weight loss, so that's a problem. Our appreciation with income portfolio for February up 4.9%. Year to date up 6.2%. Big gainer, Vistra Corp up 33%. Once again, we have Toyota in here also, up 20.5%. Ares Capital up 9%. Autoliv up 8.3%. Laggards, General Digital down 8%. Kenvue down 7.5%. Sanofi down 4.2%. Year to date, Vasistra up 41.6, Merck's up 16.7, Ares up 11.5, JP Morgan up 10. Laggards, Lamar Advertising down 10.8, Public Storage down 7, and Bungie down 5.8. Price potential, February, kind of a slow month, only up 2% in February. Year to date up 3.5. So we're seeing a bit of lag in price potential. Typically, it's a little stronger portfolio. We're not giving up on it yet, but it'll turn itself. In February, Interactive Brokers up 22.6, Cigna up 11.7. Once again, we have Caterpillar in here also 11.2. On the downside, Amphastar Pharmaceuticals down 12.7, Agco down 10. Year to date, Interactive Brokers a big gainer, up 31.1. Arch Capital up 18, AutoZone up 16.3. And laggards year to date that we're still holding, Integra Life Sciences down 15.25, and Deere is down 8.7. Small cap portfolio. We're talking about the Russell 2000 in February. We were up 4.7. Year to date, we're up 6.2. So 2 decent months there. Big gainers. Powell Industries up 56.5. That's up 110 year to date. So that stock's ripping. IES Holdings up 33.9. UFP Technologies up 23. So some big gainers in there. AN2 Pharmaceuticals, which we got out of at a pretty deep loss, down 84%. Double Verify down 22.2, NTAP down 9. So year to date, like I said, Powell up 110, Taylor Devices up 63, IES Holdings also up 39% year to date, UFP up 21. Big losers for the year, Double Verify down 16, Consolidated Water down 17. So, like I said, the small cap portfolio doing pretty well compared to the index, and as always, you have a lot of volatility in there. So that's kind of where we're at year to date. I don't see much going on the interest rate fronts. We're still seeing good, short-term returns in our treasury bonds that we're not going out very far. Less than 6 months, we're still getting 5.3, 5.4%, which is pretty solid there. We're not extending maturities very long, not at this point. I would anticipate as we start to see some cuts, that's when we'll start going a little deeper on our maturities. If you have any questions or want to discuss your accounts, please let us know.
And as always, thank you very much for your trust, and we'll talk to you next month.